Well, good afternoon. My name is Logan Schutz, and I sit on the board of directors for the Affordable Housing Conference of Montgomery County. What a great afternoon. We're pleased that you're all here. It is a pleasure to present the panel on financing and affordable housing. So you're in the right place for that. The premise of this panel is to focus on innovative strategies and financing to leverage more funding to preserve and create affordable housing that meets the need. The Council of Governments estimated the county would need another 30,000 units, and this is before the pandemic hit, so it's only gotten worse. It is my honor now to introduce our moderator for the panel, and his name is Councilmember Hans Riemer. Hans serves as an at-large member of the Montgomery County Council and chairs the Planning, Housing, and Economic Development Committee and serves on the Transportation Environmental Committee. In addition, he also serves as the chairman of the Metropolitan Washington Area Quality Committee and on the FCC's Intergovernmental Advisory Committee. Prior to joining the council, Hans was a senior advisor for the AARP, where he worked on the Auto IRA initiative, and he helped organize a community volunteerism program. He was a National Youth Vote Director and political director for Rock the Vote, and that was the candidate for the candidate Barack Obama. As a Social Security campaign director, Hans played a pivotal role organizing the Democratic coalition that stopped efforts to privatize Social Security. Thank you, Hans, and I turn the panel over to you.
Thank you, Logan. And thank you to the Affordable Housing Conference. I'm really delighted to be here today. We've got a terrific panel assembled on a topic that is really important and one where I think you're going to hear about some notable progress that's being made and hopefully come away with some new ideas and some new directions for your work. I love this topic. It's the juncture of the private and the public sector, and our ability to meet our growing need for housing, especially for affordable housing. It's really all about the money. I think if we can make money available in creative ways, and if the private sector, with a stronger private sector commitment to take risk on affordable housing, I think really anything is possible. So I'm looking forward to hearing what our panelists will share with us today. And I don't want to steal the thunder from Zachary Marks at HOC, but I hope he'll tell you a little bit about something that we have brought to fruition, which is a remarkable financing strategy for HOC to build a lot more housing, including a lot more affordable housing that is just coming online now. Our panel today is a number of very distinguished guests, and I'll introduce them in turn. First is Brian Lopez, and Brian is with Osprey, and he joined Osprey in 2001 and became a partner and executive vice president in 2003. He's been involved in all aspects of real estate development, from construction management and financial structuring of complex transactions for a number of projects, including affordable, historic, and market rate housing. And he leads their multi-family housing operation today, a significant operation. They've got over 800 million in development activity throughout Maryland and Northern Virginia. Ed Delany has served as the Senior Director and Senior Vice President and Senior Capital Officer for the Mid-Atlantic region for Capital One for their Community Finance Group since 2010. And he's got 30 years of real estate lending experience, including pension fund investments and origination of FHA insured and GSE enhanced forward commitment transactions, often using historic and low-income tax credits. He manages debt and equity investments for Capital One's affordable housing community development in the region. And he serves on multiple boards of directors. Brian Valle is the Vice President of Finance for the Bozzuto Group, and he structures, underwrites, negotiates, and executes debt and equity financing for development projects and assists in managing investor relations. Since assuming his current role with the company in 2013, he's been involved in more than 1.5 billion of debt transactions and 150 million of equity financings. And before Bozzuto, he was at the Enterprise Community Investment. He's an analyst. And then last but not least is Zachary Marks, who is the Chief Real Estate Officer at Montgomery County's Housing Opportunities Commission, which he joined in 2013. And he oversees property-related activities, including real estate acquisitions and development, property maintenance, property management, asset management. He's got 15 years of experience in the industry, and he led the conversion of the public housing portfolio at HOC through the Rental Assistance Demonstration, or RAD program, in which Montgomery County was a national leader. And I think one of the first jurisdictions that the US Department of HUD worked with in that huge national project. And he has led the entitlement design and financing of more than 860 million in transactions on thousands of units and LIHTC projects as well. As I turn it over to the panel, I want to just give a quick salute to the many incredible leaders in this county's nonprofit sector in the housing and the creative thinking that leaders like Zachary Marks and Stacy Spann and Alan Goldstein at Affordable Housing Conference and Rob Goldman at Montgomery Housing Partnership. And congrats to HOC for grabbing Tim Getzinger from the DHCA. He's a finance whiz and policy visionary who we're glad he's continuing to work in the county. And I don't know if Stephanie Killian is in the audience, but she's leaving DHCA, and she has been an absolute MVP in the housing finance arena, getting money out the door, getting projects up. And we salute Stephanie for her years of incredible work. So I will now turn it to my panel, and we'll proceed in the order that I have introduced. So beginning with Brian Lopez. Brian.
Thank you, Councilman Riemer. It's a pleasure to be here, and thank you to the Affordable Housing Conference for having me and on this panel. Some great people, especially at HOC. I've worked with Stephanie Killian in the past, and we did a couple senior housing deals in Montgomery County. So it's a pleasure to be here, and specifically with regards to Montgomery County. I think, well, even the state of Maryland and Montgomery County have been somewhat role models in creating great affordable housing programs for us to use. As you mentioned, I'm with Osprey Property Company, and we mainly develop in Maryland, Virginia, and Pennsylvania. And we have a little bit of a different model in that we don't just do affordable housing. We are a general real estate development firm. Like Bozzuto, we do some market rate housing as well, but we have recently focused a lot on affordable housing. We have used just about every financing platform out there. Again, I've been doing this for over 25 years, so it's been using both the 9% tax credits, the 4% tax credits, tax-exempt bond programs. We've used everything from back in the recessions in 2008, 2009. We used the TCAP funding from the American Reinvestment Act. And so we have kind of been through and seen it all. Happy to talk about whatever topics we want to talk about today. We're facing a lot of different headwinds with rising construction costs, with rising interest rates. We're having to get creative with our financing. I think we have used the FHA programs for a long time, and that program is oversubscribed right now and having trouble, keeping up with demand. So there's a lot of things facing the industry right now, and so I think the panel is timely, and I'm happy to talk about anything you want in terms of the financing structuring or the different headwinds that we're facing.
Great, thank you. Now let's proceed to our next panelist, who I am pulling. We're going to ask folks to start putting their questions in the chat. Really, we're going to have our panelists make very brief comments, anything they wanted to share, and then we'll turn it to our audience. So please start using the chat if you are able. So Ed Delany.
Thank you, Councilman Riemer. Ed Delany, Capital One. I've been with Capital One for about 12 years, and Capital One's community finance group only started about 14 years ago, but we are a top 10 affordable housing lender and number 3 or number 4 LIHTC investor year in and year out. So we are wholly committed to affordable housing, and we have grown in both our footprint, initially just being based in New York and the Mid-Atlantic, to now we are have significant reach out in the West Coast as well as Colorado and parts of the Midwest. But primarily we lend where we have depositors, where we have customers. We're very CRA focused in our low-income housing tax credit investments. We've developed a pretty diverse product set. We can be a construction lender and perm lender on our balance sheet, but we also have an FHA and Fannie Mae and Freddie Mac execution. And we are very active in the low-income housing tax credit, the 4% space with tax-exempt bonds. In that space, I've seen over the years that Maryland has grown in their acceptance and their ability to use multiple platforms. In addition to the FHA risk share program, we can do Freddie Mac and Fannie Mae executions, FHA executions, and all of these have been able to provide more versatility for developers like Brian and Brian to find new ways to make their transactions work. Currently working on something with Brian Lopez right now in Maryland. He mentioned the FHA HUD queue. It's huge. There's about 500 deals out there trying to elbow their way in. So we're very grateful that the state of Maryland and also Montgomery County can be very flexible in finding additional ways to help fund money, flow money into a transaction to make it work. Even though I live across the river, I grew up in Montgomery County. It always feels like I'm coming home when I do something here. And I'm very pleased that anytime we are investing in a transaction, Montgomery County is always there. They put their money where their mouth is. They step up, and if there's a gap, they make it work. So they gave me 5 minutes. I'm going to cede back whatever amount I haven't used because I know that there'll be questions later. Thanks.
Thank you so much. All right, Brian Vallle.
Good afternoon, everyone. It's good to be here virtually with you all today. And thank you again to Affordable Housing Conference Montgomery County and to Councilmember Riemer for inviting me to today's panel. I'm Brian Vallle, and I'm a Vice President of Finance for the Bozzuto Group. Bozzuto is a vertically integrated developer, builder, and property manager headquartered in Greenbelt, Maryland, but now with a national footprint. And we focus on rental and for sale housing across the income spectrum, similar to Brian at Osprey. We have a history of working in Montgomery County and are privileged to have had the opportunity to partner with the Housing Opportunities Commission on several occasions throughout the years. One good example from about a decade and a half ago is a project called Metro Point in Wheaton, which is a 173 unit mixed income community that we developed in partnership with HOC next to the Metro station using a combination of bonds, low-income housing tax credits, and other county sources. More recently, we do have 2 market rate communities that are currently under construction in Montgomery County, one in Silver Spring in an opportunity zone, and one in Chevy Chase, where we'll be delivering a total of 116 moderately priced dwelling units pursuant to the county's inclusionary zoning program. And while those are conventionally financed and not the focus of today's panel, I wanted to make sure to mention those and also applaud Montgomery County for being a pioneer in inclusionary zoning. Bozzuto is a family-owned company, and if you've ever met one of our 2,700 employees now, she or he will likely say that it feels like one big family within the company. And the corollary to that statement when we extend it to our customers is that we are a family serving families. That is a saying you'll hear a lot at Bozzuto, and it's really what drives us every day. What that means for us is that regardless of income level, we are hyper-focused on providing high-quality housing to our residents where they can come home every day and feel a sense of security, community, and belonging. And the word that we often use and to distill that concept is sanctuary. Our mission, simply put, is to create sanctuary for those we serve, regardless of income level. And so I say all this by way of introduction to our most recent partnership with Montgomery County, because I think it really embodies this ethos of providing sanctuary. That project, which we closed earlier this year, is called the Hurston, and it's a 268 unit mixed income community that we're very proud to be developing in partnership with HOC and EYA next to the Shady Grove Metro on the Red Line. Incidentally, for those who are curious, the Hurston is a tribute to Zora Neale Hurston, the renowned African-American author who lived some of her most formative years in Maryland and also was a graduate of Howard University. So we thought it was an appropriate homage at this community to name it after her. So the Hurston is the latest phase of a larger 45-acre mixed-use neighborhood that's being created next to the Shady Grove Metro Station through a public-private partnership between Montgomery County and our co-developers EYA. The project itself is 70% market rate and 30% affordable. 25% of the units are affordable at 50% of AMI, and 5% are affordable at 65% AMI. With a mix of studios, 1 bedrooms, 2 bedrooms, and 3 bedrooms. So we'll have a very diverse set of households at the community, all of whom will have access to new state-of-the-art amenities in a very vibrant environment next to public transit. The project also has a mix of uses, so it'll have about 21,000 square feet of retail space and about 7,500 square feet of office that will be occupied by HOC, who will be moving their up-county service center to the location when it's done in 2023, I think, is when we're going to be complete. So, so that's a little bit about our latest exciting project. In terms of financing, thanks to the commitment of Montgomery County and the incredible work of Zachary Marks, who you'll hear from shortly, as well as Kayreen Brown, Stacy Spann, and the entire HOC team, Bozzuto, HOC, and EYA were able to finance the Hurston without low-income housing tax credits. Instead, we were able to recycle about $100 million of bond volume cap that was freed up through redemptions from other transactions. That capacity was in turn used to finance an FHA risk-share credit-enhanced mortgage that had a very favorable rate and provided a majority of the financing for the development. We also received a commitment from Montgomery County's Housing Initiative Fund that helped fill out the capital stack along with equity from the joint venture partners. So I have to tip my hat again to HOC and Montgomery County for their creativity and commitment to this transaction. Bozzuto is thrilled to be part of a development that addresses a lot of the county's housing priorities, and we're hopeful to partner with them again on something similar in the future. So with that, I'll turn it back to you, Hans.
Thank you so much, Brian. And Zach, I know you've got a lot to share with us. Let's hear from Zachary Marks at HOC.
Thank you, Councilmember. It's good to be here with you and my fellow panelists today. And thank you to the Affordable Housing Conference. This is always, while we can't be there in person, this is always a conference that just has, a ton of good discussions like this one that really get down to brass tacks. Just sort of picking up where Brian left off, in terms of some of the core innovation that space that really is out there for affordable finance. Councilmember Riemer and with the support of his colleagues on the council, really, he really stepped out and sort of said, let's figure out how to do something innovative around affordable housing that really focuses on, in particular, the Council of Governments production goals. How do we improve production? Because we know there's a lot of hard work going on at planning and with the council and others around how do we fix the ability to build housing with zoning, but you got to be able to finance this stuff too. And as all my panelists know, probably painfully, affordable housing is almost always financed with like 19 different sources of capital. It's never the same combination on any given deal. And so, silver bullet thinking is really not usually very successful when it comes to affordable housing. It's really about augmenting, some of the strengths that are in place and trying to eliminate some of the things, some of those obstacles. So what we came up with was the housing production fund, and really what it does precisely that. It plays to really HOC's strengths around its mixed income model, but also its ability as a housing finance agency to permanently finance things fairly well. And this housing production fund, oddly enough, building off what Brian just said, the first transaction that it will fund is actually the Hurston. So that HIF funding that came into the Hurston to help it get going, to solve some timing issues, that was about a $14 million check that the county wrote to finance housing. So talking about, everybody that says Montgomery County puts its money where its mouth is, you can say whatever else you want about the county. It puts its money where its mouth is on affordable housing, and that's been true for a very long time. And so the Housing Production Fund is designed to replace construction equity that is usually can be pretty expensive, particularly in the private sector, or the alternative is it locks up a big number, a big part of the HIF, like $14 million. And instead it utilizes HOC's ability to issue bonds, the county's ability to provide support in terms of the payment of principal and interest around those bonds, but it can replace that construction equity during construction, which is where the weakness was, because oftentimes you can't get high leverage loans during that period. Once you're stabilized, you can get those high leverage loans, and then you don't need that construction equity anymore. So the Housing Production Fund plugs into things that HOC already does well, and it gives, we're governed by a Board of Commissioners that need to have confidence that all the resources are going to be there to be able to go to chase these next deals. And so the Housing Production Fund is just a huge win in giving the commission the sense that, here's a brand new resource that allows us to then pay that $14 million back into the HIF. So that's now available again. And instead, the Housing Production Fund is being supported by a much smaller amount from the county, and can be offset by actual project interest from the projects themselves. And so the net amount is quite small. I'm happy to get into more detail about how it works. It sounds complicated, but actually for affordable housing, it's pretty simple and elegant, which rarely happens. So, but it's just exciting to have gotten the opportunity to work with council on that. To have that political will is very valuable. And then to be able to put it to work on a project that's at a metro station that has 25% units at 50% AMI, and to do that right away so that we can produce is pretty exciting.
Awesome. Thank you, Zach. I'll make a few quick comments and then we'll go to our questions. So thank you for bringing up the Housing Production Fund and your work there at HOC, and it really was a delight to be able to partner with you and the private companies that you've worked with to do your remarkable developments in recent years. And thank you to Bozzuto for all your partnership, and EYA. Maybe there's someone from EYA listening in. We're really grateful. The polling companies as well. So what we've done there, we created a $50 million fund that HOC uses for that construction term and then repays, so it's self-sustaining. And we think we could make it bigger. We expect with that resource, HOC should be able to make somewhere in the range of 800 to 900 housing units per year. If the county can really step up with land and help HOC get access to a pipeline of land, this is about going to scale with a mixed income model that HOC has really pioneered with our private sector partners. And so we're thrilled to see it get started and can't wait to celebrate at the groundbreaking for the Hurston. Didn't know that Zora Neale Hurston had time in Maryland, but love her work, and great choice there. So let's keep our eyes on this program, and I think there's a lot of potential to grow it. A few other signature initiatives recently. The council adopted legislation that I proposed with Councilmember Friedson to exempt significant new developments on metro property at the stations from property tax for 15 years, a pilot legislation. We're hoping that that will lead to some very significant new development on top of our metro, where those stations have tens of millions of dollars of legacy costs that kind of sunk into the ground that have to be overcome in order to get going. And we're hoping that that pilot will basically allow projects to get over the hump. Imminently, the PHED committee will be introducing legislation to provide a pilot for any development that achieves a higher level of affordability. Shout out to AJ Jackson and the team that he's working with for putting really a focus on the need to help our nonprofit partners have more predictability when they want to get into a transaction, especially for acquisition. So we're gonna create a pilot, and I'm sorry it's been a little slow, and we're working hard, but there'll be legislation coming forth imminently with the pilot bill, so that you'll have a predictable pilot. You don't have to negotiate first. You'll probably still negotiate other financing, but it won't be that piece of it. We have also created an impact tax waiver in the opportunity zones in the county. So we're hoping that that will help juice up the housing market in areas that are a little bit more challenged. We've added more funding to the HIF, so the DHCA generally has more funding available for all the projects. We are, those are just some of the initiatives that we're working on. So having said that, we've got a few questions. I'm going to start with one from Delegate Julie Palakovich-Carr, who has been working on a lot of different issues representing the largely Rockville area in the state legislature. And thank you, Julie, for tuning in. And Julie's interested from our panelists to hear about state level work. What are a few things, or one or two things you think we ought to be pushing the state on, or something you would want to say about what work could be happening for a state policymaker to take a look at and focus on. So why don't we, we'll throw it open to our panelists.
I guess I can jump in. I do, a lot of affordable housing broadly throughout the state. So I can talk to this issue, and like Zach and Brian pointed out, with these transactions, it's not just a state transaction, but it always involves state money, federal money, local money, and private money. So they're always a layered financing structure. And Secretary Holt was on here earlier, but he highlighted some of what they are doing. What I can tell you that they are doing is this administration has been pretty creative in terms of how they're financing projects. They've introduced twinning of the financing, which was popular in Virginia as well, but trying to combine tax exempt and taxable 9% and 4% tax credits so that you can do bigger projects. The state has also really pushed the rental housing works program so that they can introduce additional bond finance programs. The rental housing works was funded at, I want to say 38 million, I think, this year, which was up from 25 million last year. And that program has continued to leverage tax exempt bonds, which is a huge increase in tax exempt bond projects over the last 5 years. So they are doing a lot. I think if most of the projects financing does come from federal sources for the tax credits, so pushing to get the federal resources increased is a huge item as well. I know with the Affordable Housing Act that they're trying to push, that would increase the amount of credits available, also provide boosts so that we can produce more housing. But I think the biggest thing is the state can do is just continue to try and be creative. As you heard from Councilman Riemer, he's introduced a lot of initiatives for entitlement type of issues that help affordable housing. Those sorts of things, if they can be creative with different initiatives and how they use the money, I think that's how they have to try and increase their productivity. So.
Yeah, and I'd like to layer on to a couple things Brian said. As most of you know, we have the 4% fixed credit finally for tax-exempt bonds, which is great. But there's a companion piece which is being pushed, and this is on a national level. And if the state and the legislators threw their strength behind it, I think could help. And that would be the 50% test. The developers here know that one of the reasons why tax-exempt bond deals are tough is that we have to fund 50% of the development cost with tax-exempt bonds, even if the permanent debt with those bonds might be a significant fraction of that. So lowering that 50% test would make more volume cap available for more deals. We wouldn't have to lock it up. Now, granted, sounds like Zachary and Brian found a way to reuse some of that recycled bonds, but if that money was available up front, there'd be more bond deals that could be done, and that would stretch that resource. Another place where I think the states getting behind a federal legislation would help is income averaging. A few years ago, we got income averaging, and it sounded like a great idea. You could have low-income housing tax credits for up to 80% AMI, and that 80% is equal to what HUD calls low income. And where that's really important is in areas where high income areas, especially like Montgomery County, where a lot of people are over income. They make more than 60% area median income, but they can't afford a market rate apartment. So it seemed like a great idea, but there was a concern among investors that what happens if you missed that mix, because there weren't really very good guidelines. Well, IRS came out with some guidelines earlier this year that was through half the investors in the country, had them running the other direction, because it looks like there could be a cliff if you messed up on your mix of your average of 60% of the units. So I think the one place where everybody could get behind is reaching out and trying to get the IRS to come back and have some reasonable guidelines so that the income averaging can actually be a tool that will allow areas like Montgomery County to expand the affordability for people from 30% to 80% of area median income.
And I guess I'll just piggyback on that, because the good thing about the recycled bond structure, which is another one of those kind of innovations, the good thing about it is that we're reusing a resource that's pretty scarce. So, Ed's talking about volume cap, which is actually in many ways more challenging. Although we love the fixed 4, the volume cap issue is almost more challenging. And so recycling the cap is great, except you can't use, and this is getting super duper in the weeds. So please mute if you're snoring. But the recycled cap can't be used with tax credits, so it doesn't solve that problem. Whereas this potential to lower the requirement for instead of it being a 50% test, being a 25% test is huge, because you're effectively doubling, in many ways doubling the availability of volume cap, without which you cannot do 4% credit deals, which are a big part of housing, affordable housing production. I would also add that there's absolutely no reason the HPF the Housing Production Fund can't be done at the state level. It could absolutely be done. And again, it creates a different model than in the same way that the HPF helps us to avoid taxing, the HIF as much, leaving the HIF for projects that don't have the advantages of the mixed income structure, but are still nonetheless crucial deals. So, you can create you can effectively create a different channel for financing that helps take some of the stress off of these core resources. So I think that's important. I also think, even though it's not directly related to financing, but it's a part of making things financeable, and that is looking at more state control of zoning, because that's what makes a lot of these deals so expensive and harder to finance, are the intricacies around entitlement and so forth.
And if I could just pick up there too, I've had conversations with developers across the region. And if there's one thing that's consistent is that even in counties like Montgomery County or say Arlington or City of Alexandria, places where they do put their money where their mouth is. They put a lot of money into affordable housing. They make it a big effort. The entitlement process itself takes forever. And I'm sure Brian and Brian can really note. I mean, sometimes, I hear about a deal sometimes 2 years before it closes, and you guys are in it for 4 or 5 years before we can ever get to a closing. And that is the entitlement process. If the county and the state really want affordable housing, they have to find a way, I think, to have a fast lane for entitlement for affordable housing. They don't necessarily need to skimp on their requirements, but make it easier. Make it easier to get your building permits at the end of the day and not spend 4 years trying to get through your entitlements.
Yeah, that's a great point, Ed, because as developers, the 4 to 5 years or sometimes longer, that period we are carrying that risk. We're funding pre-development. That's carrying costs on our lines of credit. It's a lot of money that we're sinking into the process that if the process is not clear to get to a closing, that can be a hurdle to making a decision to develop these units in the first place. So I agree with you 100% there. To that point, not necessarily a state issue, but Zachary hit on the cost issue. I mean, costs are increasing, continue to increase on the development side. Lumber is, 3 times what it was a year ago. All other costs have continued to rise during a period when a lot of people thought there would be some relief during the pandemic. So, any way to try to attack that side of the equation in terms of financial feasibility is helpful. One thing that comes to mind, at the risk of sounding like a broken record of developer tropes, but parking requirements, parking, especially underground parking, structured parking is really expensive. And, notwithstanding the state of public transit these days, and, especially with the development of the Purple Line and with increased development near transit, just a way to get relief on parking, I think is helpful as part of that process from a development standpoint and trying to keep costs down.
Okay, well, those are 2 very county government focused recommendations to streamline the development process for affordable projects, which I've not the first time I've heard about the need for that. And it's about time for us to come up with an idea there. And I think actually, I think we've talked about this, Zach, haven't we? And relief from parking requirements. I'm under the impression we don't have parking minimums in a lot of locations, but I know Gwen Wright may be on the call. Perhaps she'll chat me with some response, but we, it's $50,000, $60,000, $70,000 of parking space sometimes, right? That's like a lot of money. I should have mentioned, and I didn't, one of the other changes we just made in our policy generally on housing was a kind of a right sizing of impact taxes. And those are becoming a big hurdle for a lot of projects to move forward. And we also tie them more closely to their actual impact cost. And so when you combine all these efforts, I think you'll see the county council has been making a huge and I think really unprecedented effort in the last couple of years around housing finance to support the development of affordable housing and generally to support a dynamic housing market that can meet the needs of our growing workforce. The slowdown of annual housing production over the last 10 years, that cascades. We see in California, homelessness is driven by the lack of housing that's available. And we're not immune to that here. So 2 questions I want to ask, and I think we'll take them sequentially. We've got Jeff Mosley has asked about the need for support for those with very low incomes or no incomes. If one of our panelists can talk about how they are able to fit into some of their projects, units for those who are barely paying rent or may not be able to pay rent. And then we'll move to the next question from Josh Sloan about the difference between financing rental versus for sale and ideas about addressing the path to home ownership. So why don't we ask one of our panelists to start with the effort around those with no or low income. And Gwen Wright has just put into the chat a link to our Speed to Market initiative, which is I think a broader strategy intending to accelerate the timeline for projects coming to fruition, which, as was said, is a huge time that a developer has to carry that risk. So it has a big impact. So let's hear from some of our partners about support for those with no or low income.
I guess I'll just do this in order again. I'll jump in, but it's a tough, I mean, it's a numbers game. When it comes down to it, it takes money to serve the lowest income groups. You know, if you're talking about serving somebody who's at the 30% income level in Montgomery County, your rents are being pushed down probably to about a third of what the market rate rent would be. So you can't, it just becomes an expensive process. So in Maryland, well, across the nation, the 9% program is generally the program in which we use to get those rents down to the lowest levels. But it's a limited resource. So in Maryland, you're capped at $1.5 million worth of tax credits for a 9% transaction. And the number of units that you can build in that program is probably limited to 40 or 50 units now because of the cost of producing those units. So again, getting to those lower income units is really, again, we keep saying, bringing it back to the local level. Montgomery County is incredibly progressive in their policies and the amount of support that they give to projects, but that's not happening anywhere else in the state. Very few counties are as aggressive as Montgomery County in providing funding and resources, and even the entitlement process, having MPDUs. Very few places in the state do what Montgomery County does in order to serve those lower income residents. And so it's really hard when you have to be able to pay your mortgage, you have to be able to pay your operating expenses. So it's very hard to serve that very low income resident without a lot of subsidy. I did hear earlier in the session, one way to serve it is to expand the voucher program. And I know the federal government's working on that, and that seems to be probably the best route in expanding opportunities for the lowest or no income residents.
Yeah, let me jump in again here too. A couple things Brian said. Certainly subsidies, because if you look at what you can actually charge in rent at 30% AMI, it barely covers your expenses. So that's why it typically works best in the 9% program. Just you can't support the debt at the 30% AMI level, and then or even lower. Just to pick up on what I said before, one way to help would be fixing the income averaging, because you can offset an 80% unit with a 30% unit, and the property will average 60%, but then you have a little higher income on one side that helps support it. And this can work better than having a small amount of the units as market rate unit. And the reason for that is, if you're just going to say, I'm going to put 10% or 15% of the units as market rate, it's tough to actually get pure market rent on those units. You're not offering the same kind of amenities in a 100-unit low-income housing tax credit property where you might have 10 to 15 units at market rate that you're offering in a 200-unit brand new property that has the pool and the concierge and everything. So you're not getting full market rent. But if you have that 80% unit to offset that 30 or 40% unit, then you can actually make the math work and make it work like a normal low-income housing tax credit property. But there is something else that needs to be addressed when you're talking about serving the lowest income. Typically, we need more than just rental relief. You need supportive services. The folks that are at the 30% AMI level or lower typically need to have some additional support. And, you know, we can and we have at Capital One supported on a one-off basis on project to project. We've done some support of assisted the sponsors in paying for some of the supportive services, but it's not enough, and we can't fund the full thing. So we need to have a will by the state and the counties to allow those financing structure that will enable those supportive services to be either funded above the line or else find some other source to pay for those services, that is.
Just wanted to follow up on one point that Ed also made. To give you an example, again, Montgomery County has a benefit of being in the DC MSA and much higher rents. But if you pulled up a spreadsheet, so our maximum rent in the Baltimore area for a one-bedroom unit is at the 30% level is $565. Our cost to operate is about $625 per unit. So it just, you're almost upside down from the start, and that doesn't include paying your debt service. So again, that's the hardest part that we have, is you have to have higher income units to offset the lower income units.
And I mean, I'll just quickly throw a few themes out there. I mean, first and foremost, like Brian said, I think it gets brushed past a lot, but honestly, they're very expensive units. So it takes funding. Like it gets brushed past a lot, like as if we're not delivering 30% units, and we are, but it's as if we're not doing that because we just don't want to. It's just because they're expensive. So first and foremost, it's money. But in fact, the way these things often get solved is, again, not by a silver bullet, but with layering of things, which is why our projects are often so complicated to finance. So delivering MPDUs is actually highly effective for actually serving lower incomes because of the voucher program. So it's the combination of those two things. So delivering at 50 and 60% AMI, these units are not necessarily not serving folks of lower incomes. DHCA is very often opportunistic about, then they can come in and buy those 50s down, but they're not as expensive because the developer got it to 50. DHCA came in and got it down a little bit further. So it's that kind of collaboration and that kind of layering. And lastly, I'd just say it's also going to take some real creativity. So repurposing assets in strategic ways. And frankly, just it's going to take a lot of hands working together. Part of the reason why we at HOC started with really the first thing out of the gate that I did starting 8 years ago, was the RAD program, was to make sure that the existing safety net for folks that make 30 to nothing was fully reinvested. So, and that was a long and expensive process, but it was very important to get the existing stock. So there are some really creative ways that are out there, fair cloth capacity, for instance, to actually add new subsidized units in that 0 to 30.
And the only thing I'd add is that a lot of the soft money sources out there that are competitive incentivize the production of those low-income units, very low-income units, and offering of supportive services. So Federal Home Loan Bank comes to mind, their AHP program. So to the extent that you are trying to fill out your capital stack, a lot of those programs, just by virtue of how they're scored and awarded, will incentivize the production of those units.
Thank you. From a policy perspective in Montgomery County, we really have to have a holistic mindset. As Zach was saying, creating new MPDU units through new development means we're putting units on the table that we can then grab with subsidy programs and discount the rent so that they're affordable to people with low and no income. So, we hear from our residents all the time, oh, look at all this luxury housing going up. But what they may not appreciate is inside those buildings are a large share of units that are going to become available to people with low income. And there really is no way to produce new housing for people with very, very low income other than through a subsidy. And so, that's one of the ways that we are able to expand the number of units that are available. Not to mention having a strong growing housing market. New buildings will suppress the growth of rent in old buildings. And so that helps preserve your existing very affordable housing stock. One of the questions we have is, does the county have any bridge funding available for acquisition of expiring low-income housing tax credit properties or other committed affordable properties? Thank you, Brian, for the question.
I guess as the quasi representative of the county on the panel, you know, both HOC and DHCA, you know, are generally, you know, we're generally on that wall. So yeah, I think the answer is yes. First and foremost, the HIF, you know, the HIF funds are kind of catch-all in that way that, you know, DHCA is really looking for, you know, worthy preservation projects. HOC and DHCA have used the right of first refusal to preserve precisely these kinds of properties as well. You know, HOC, just like everybody else, secures resources like that. But if you know, if you see an at-risk property, it's always good to go chat with the folks at the HCA and let them know that this seems like a good preservation effort, and you know, that's precisely why they're there.
HOC recently acquired the Cider Mill property in Montgomery Village. I understand one of the largest acquisitions of a property to preserve for affordable, maybe in the country that year. And you did secure some bridge funding from the county, is that right?
That's correct. So again, it's all about collaboration. You know, nobody's got the magic seeds. So yeah, it was a right of first refusal. It was a really large acquisition, 864 units. And we could not have gotten it done without, you know, our teammates at DHCA. And so we're often collaborating in that way. Because you know, a lot of the most vulnerable housing, you know, there's a lot of the like triplexes, you know, 4 and 5 unit buildings that are vulnerable, but there are also these large institutional size deals and everything in between. So it definitely takes collaboration.
And for, you know, oh, go ahead. Yeah.
I was just going to add, I mean, the bridge funding is it's a good point. The bridge funding is really important if you're trying to preserve, because preserving it is actually most likely less expensive than trying to build it. And without the bridge funding, you're competing in this market, especially in the more affluent areas and jurisdictions. You can't compete with some of the market rate buyers that are paying 4 and 5% cap rates to buy these projects and try and turn them to market.
And that's why we got to get this pilot legislation done, so that a mission-oriented provider will know with certainty that element of their financing. Because if you want to go get a property, it's kind of too late to come in and try to negotiate a deal with the county and then go out and buy it. It's already gone. You know,
Yep.
you got to have something lined up in advance. So that this pilot will be very useful for that strategy. It's essentially a type of bridge financing, I should think. It won't be the whole piece of the puzzle, but it's a layer. And the executive branch has a new fund they're building that is called the Housing Opportunity Fund, that is intended to also provide some bridge financing, short-term financing for projects that, you know, presumably will be more acquisition focused. So we're looking forward to seeing how that develops as well. So there was a question about the difference between financing strategies for rental versus for sale affordable housing. Does any of our panelists have some insight on that question?
I mean, it's completely different financing. I think you mentioned the rent to own on that question as well, but in areas where they have MPDUs, that's somewhat how they do the for sale. The builder basically is incentivized to provide some additional units at affordable prices, and they're incentivized by increased density or other ways that improve their profit margins so that they can provide it at the lower level. But that's generally more conventionally financed with a construction loan and taken out. The tax credit programs and the affordable housing programs are almost all predominantly or exclusively rental programs. Through the tax credit program, you can do a rent to own, but you still have to go through the initial compliance period. which is 15 years. So it's not used often. We're using it now in 2 projects that are coming close to that 15 years. And you can offer it for sale at the end of the compliance period. And you have to make sure that it maintains affordability. So it's a little bit complicated, but it can be done. But again, the programs that we use for producing the affordable rental housing, generally your units are garden style apartments or apartments. So it doesn't necessarily fit a for sale model.
Just to add there, Josh, who asked the question, the council just added $1 million from the HIF towards home ownership, kind of down payment assistance. I think HOC is often one of the partners that will help people on that ladder into home ownership, but we also recognize the need to expand ownership opportunities, and we added some funding there to support that ladder. All right, we got 3 minutes left. Maybe any of our panelists have something that came to mind and they didn't get a chance to say yet.
I did want to make a quick distinction. It occurred to me when Director Wright posted the Speed the Market initiative. I wanted to make a distinction about, the question about what could be done at the state level. There's a difference between the entitlement process and zoning, and so I think where the state can be helpful is sort of targeted, targeted changes to how zoning works, as opposed to the entitlement process. Obviously, the Speed the Market initiative is very exciting, and Director Wright and her team have been very focused on working with council, with the executive branch, county executive, and trying to make really important changes around the entitlement process. But I do think the state can play a role by, frankly, giving some of these localities some better coverage around zoning specific to the actual code and law that could be supportive to the planning department and others in terms of making entitlement even easier. So
go a little deeper there, Zach. You mean create some zoning policy essentially that flows down from the state to the county that creates certain entitlements?
Yes, I made it 58 minutes without getting in trouble. So, really, there are some things that have to do with just zoning in particular, right? That just, here are the things we write that zoning code based on a whole host of things. But there are certain things that states could do. There are states across the country that are making broad changes in terms of what you are allowed to do, what you are allowed to restrict as it relates to zones. And
so I'll take it from
Thank you.
Your point.
Thank you.
Zoning has always been the province of the county governments, and I think it's a fair question to ask whether that's serving us well. And are there certain public goals that override those institutional alignments? And can the state, as you're seeing in other state legislatures, they're saying there are some issues that are so important we got to make them at a statewide level. We can't let communities make this decision in the wrong way. And I think that's a absolutely fair conversation to have. As the chair of the PHED committee and the chair of the zoning committee in the county, I wouldn't be shy at all about talking about what are some principles that the state should put in place and that all counties would need to abide. All right, I think that's going to wrap up our conversation today. It's 1 o'clock. Thank you so much for your participation, and thank you to our panelists for taking time to bring us your insights and offer a terrific conversation to the participants in this conference. And thank you to the Affordable Housing Conference. Really appreciate this gathering. It's an important part of the year for all of us. So, all right, everybody.
Thank you.
Thank you.
Have a
great
good
day.
afternoon all.